All right. Well, good morning, everybody. It looks like we've got 54 people here. We've got 118 registered for this Ag Outlook and PARP today, which is astounding. It's awesome to have that many people registered. We also have folks that have registered from Florida, Michigan, and Ohio, which is the first time we've ever had this happen for this Ag Outlook. So we were all joking on the call earlier before we let everybody in. We typically have some sort of frozen precipitation on the morning of this event, and usually a little bit delayed or have the attendance reduced because of that. So I'm hoping the commute was good for you all today from the bedroom to maybe the dining room table or the office. So but yeah, I think we've got a good program scheduled today. We've got Howard Halderman from Halderman Real Estate and Farm Management.
Continue to space people out in the community to get their vaccine, so that isn't a potential
well. So we're going to need to make sure that we mute everybody as we come in. That's perfect. Thank you. So we've got this partnership has been occurring over the last 5 years between Halderman, First Farmers, and Purdue Extension. We've offered this program every year. We've altered the times. We've had it in December. We've also had it in January, and so the January program really kind of sticks with us here. But we've added PARP credits to be able to boost attendance, and I think that has worked out pretty well. So we're going to go ahead and get started this morning. I'm going to go ahead and stop sharing my screen, and I'm going to allow Howard to go ahead and share his screen. He's going to give us our Ag Outlook for the 2021 growing season. So Howard, go ahead and.
So Austin, are you seeing my screen the way we intend?
Yes, sir.
Okay, so you see my first slide, the cover slide there.
Yep.
Perfect. All right, good morning, everyone. And from the Halderman Companies, I do want to welcome you all this morning. As Austin mentioned, really dealing with ice, snow, something on this morning. I don't know how many times we've driven from Wabash down to Tipton to see Tipton High School on some sort of delay or closure as we're holding our seminar. Of course, you guys always show up. So regardless of the weather, we've always had great attendance at this. Do miss seeing everyone, miss the breakfast, miss all those interactions, and I'm sure that we'll be back to that soon. But in lieu of that, we do have the opportunity to have people join us from across the world. Not that we have anybody outside the U.S. today, but certainly from multiple states. So welcome, everyone. Want to introduce the Halderman staff that helped put this together. I think they're on today, but you have Jarrett Wicker out of Noblesville, Sam Clark out of Noblesville, and then John Miner from our Greentown office that are the three area representatives that represent this region for us. And also want to thank Purdue Cooperative Extension as well as First Farmers Bank and Trust. As Austin said, this is a great partnership for us, and we've really enjoyed the opportunity to work with these two organizations on this event every year. So my hope is that the screen share works as intended, and we'll get started. Just a brief introduction about who is Halderman. You know, we've been around 90 years. We're actually in our 91st year this year in 2021. My grandfather started the business here in Wabash 90 years or 91 years ago. We've got an ability to help landowners. That's our specialty, and it's farm landowners. We don't work in commercial property. We don't work in residential or industrial. We specialize in agricultural properties, and we provide farm management, real estate sales, and appraisal services to a whole host of owners. But basically, if you own farmland and you have a question about how to lease it, how to sell it, how to, what might it be worth, those are all questions that we receive and answer on a daily basis. You can see the scope of our business continues to expand and grow. A big growth area for us in 2020, and a lot of businesses unfortunately didn't experience growth in 2020. But agriculture, as all of you know, was an essential business, always is an essential business. And one of the things that really grew for us were the farm appraisals. And those numbers were up quite dramatically this year, I think largely due to the refinancing boom that existed due to lower interest rates. And so that's one of the topics that we will cover here shortly. And then you can see the, kind of the corporate staff and how many area representatives and real estate associates we have today. And then the geography that we cover. But I'm not going to cover all the United States. This is a Tipton County event. It's a central Indiana event. So that's what we're going to talk about today, our farmland values in central Indiana. And as this slide says, values are strengthening. And I've had a lot of people ask that are not in the agricultural field. The question they ask me is, what's happening in the agriculture industry? And I can tell them very honestly that through COVID, go back to April, May last year, we saw no dip in farmland values. The market did largely shut down. There wasn't much that traded hands in May, June, July last year. But the values basically remained steady. And then as we got into the fall and we saw pretty good yields combined with better commodity prices all throughout the fall, we've seen values continue to strengthen. Don't miss the interest rate component in that as well. So it's in an industry that I think is looking at better times right now. And we'll talk about a lot of variety of reasons why that is. So one of the things, and I don't know how many of you watch the farm newspapers or go online and look at various listing sites, ours and others, but right now there's not much on the market. It is a tight marketplace, and there were a number of sales that we did back in October, November, which is a traditional time to see farm real estate sell. But honestly, the number of farmland sales has remained below average. And that has been the case since really 2012. If you go back to 2012, you would remember in that August to December time period, we saw a lot of sales, and it was all driven off the fact that there was a concern that with Mr. Obama being reelected, most likely being reelected, and potentially a Democrat Congress, which would be similar times to today, that we would experience higher capital gains tax rates. And that fear in 2012 led a lot of people to move their sales into the early part of the farm sales season, and we had a lot of sales then. Since then, since 2013, we have not seen really any outside drivers like tax law change that would create that kind of dynamic. So I bring that up and I spend a little time on that this morning because we are entering a time period of unknown. You have a new Congress, you have a new president. And so as a result of that, what will be their agenda? And will there be tax law changes that we could foresee coming? Estate tax is something to certainly watch. Income tax and capital gains tax are a couple other things to watch closely. And what might those impacts be on farmland? The Farm Bill is still secure for another couple of years. That's not up for reauthorization anytime soon. So the Farm Bill is probably not going to be anything that moves around, nor crop insurance. But I think the key thing to watch will be that tax law. So we've been experiencing a below normal number of farmland sales. Cropland values have really been in a sideways channel, and we'll look at some slides on that here in a second. But what's going to happen going forward? And I think we're looking at some dynamics right now that would suggest that the market is moving stronger, certainly into the end of last year and as we look to 2021 and what we know on January 7 or so. Recreational timber and rural residential values had been basically trending higher over the last 9 to 12 months. And you'd think, well, with COVID, would that slow things down? Well, any of you that watch the Indianapolis residential market or the residential market across the United States have known that residential values have experienced a real boom time. Houses stay on the market for a very short period of time, if they even hit the market. And that has spilled out into the rural communities. And we've seen a number of folks, because of the technology that we're utilizing this morning, that have said, you know what, I can work from home. And because of that, I'm fine with living in a more rural setting. And in fact, I might look at that as being safer today. And so recreational and rural residential values have trended higher, which was really a change in what that marketplace has experienced over the last few years. Low interest rates help that, as well as the COVID fears. Federal Reserve Bank of Chicago, they'll come out here in the next few weeks with the fourth quarter results. Basically, I think that'll be a kind of a January report. But you can see from October to October, the district, which is Indiana, Illinois, Iowa, Michigan, and Wisconsin, the overall 7th district saw farmland values go up 2%. Indiana specifically was up 6% year over year. So as I suggested just a couple minutes ago, farmland values are really trending fairly positively right now. And now we're looking at corn and soybean prices that might even ramp that up further. So if you're a farmland owner, that's good news. If you want to buy farmland, well, maybe you should have done that 6-12 months ago. Although hindsight's always 20/20. So here's the Purdue Farmland Value Survey. It's done every June. So if you think back to last June, what's interesting in this is that we did not see anyone think that land values went down last June. And that was a pretty questionable time, right? We were just coming out of the initial COVID scare. Vaccines were long in the horizon at that point in time. Yet in that survey, you saw all 3 land classifications move up a little bit in value. So again, why might you want to own farmland as part of your investment portfolio? Because it's pretty stable, especially in unstable times or chaotic times like we were experiencing back then. So basically, this just indicates that slight sideways channel that we've been experiencing with a little uptick toward the end. Again, mirroring what the Federal Reserve Bank was showing. So I want to talk about this sideways channel, and I left some older slides in here just because I wanted to talk about the trend. So back in 2013, farmland was trading, and this is a measurement that Pat Karst, our Vice President of Real Estate, does for us. Basically, he takes the sales that are high percentage cropland, and he takes the sale price and divides it by the weighted average productivity index of the soils on that farm. So you can map the soils of a field, any field, and it'll come up with an average productivity index for corn. And it will be somewhere probably between 100 and 180 here in Indiana. And the better soil types are going to be at the higher end of that range. And so if you see 150 bushel to 180 bushel farm, that's going to be above average. You know, that 130 to 150 range is average, and then below 130 would be below average. So we basically take that sale price and divide it by that productivity index, and we come up with so many dollars per corn bushel of productivity. And back into all-time high of farmland values, that traded somewhere over $60 per corn bushel of productivity index. And so as we chart this, you can see in 2014, that began the decline. Commodity prices were eroding, interest rates were up a little bit, and so we saw a decline from the low 60s into the middle 50s. 2015 was really the bigger decline, and what was interesting is we started the year of 2015, we reverted back above $60 per corn bushel, but we ended the year right at 50 or right below $50 a bushel. And so when you look at that, anywhere from 15 to 20% decline in all-time high land values, it occurred largely in 2015. And as that first slide of mine said, we've been in a sideways channel since that time. If you look at 2016, there's a lot of movement throughout the year. Different qualities of farms, different locations factor into that. Sometimes you'll have a real sandy farm up in Northwest Indiana, for example. That'll have a low productivity index, but it'll sell for $8,000 or $9,000 an acre because it has an irrigation pivot on it. Well, that'll skew that value up. And so you might see some of those sales pop up to the high end. But basically, all of 16 hung right around $49 a productivity index bushel. 2017, very similar, although a slight trend toward the end of the year. 2018, wow, that looks like 2016, almost similar number results. And then 2019 began the year a little weaker, finished the year stronger, but right at that average of $50. Well, here's 2020. We began the year a little sluggish, right at that average we've been at, $48, $49. And we ended the year $53, $54. So again, confirming what the Purdue survey shows and what the Federal Reserve Bank shows, our trend, our actual sales results would confirm what those opinions would be in those other two So we have not done any auctions in 2021. No surprise since it's January 7th. But here's that trend, that 2016 to 2020 5-year trend that has basically been a sideways channel for farmland here in the Eastern Corn Belt. Now, to look at it graphically another way with a bar chart, you can see that where we were over $60 back in 2013, if you go back to 2016, you might see just a slight trend up if you were to put a trend line on that. But basically just showing you another way to look at that, that sideways channel that we've been in. We do have a Halderman Companies app. My marketing department would be disappointed if I didn't promo that. That's something we just redid in the last few months. Approved by both Google and Apple. So if you know, depending on your operating system for your phone, you can download that. That'll show you all of our auctions, all the auction results. You'll see them pretty real time as they come out on a regular basis. So here's a survey I did, and I hesitated to leave this information in the presentation today because this survey was done back on September 1st, and my have times changed since September 1st. That was largely before harvest. Now, we assumed we were going to have pretty good yields, but that was not yet confirmed. And commodity prices weren't anywhere close to what they are today. So I want you to think about what our survey results are with that backdrop, because I would imagine our staff, if I surveyed them today, would give you different answers than what they did on September 1st. But basically, I asked our staff, what was the change in farmland values from September 1 of 19 to September 1 of 20? And you can see that there were some opinions that maybe the best cropland was up 7% and maybe it was down 10%, depending on location. So kind of an average of very neutral. The same with average cropland, a little more bearish. But then you saw a pretty positive response for woodlands, residential building sites, and rural residences. Livestock facilities a little weaker. And you think about hog prices largely, or dairy, they have been a little weaker up until that time back in September. I also asked them dominant purchasers. This is always an interesting question. These are our actual sales results. So this isn't an opinion. This is our actual sales results. And we'll conclude an auction or a private sale, and we will write down, was that buyer an investor, or were they a farmer, meaning they're going to own and farm that farm themselves? And you can see in 2019 and 2020, an overwhelming majority has remained the farmer. And never really goes below 50%. You got to go all the way back to 2011 for that. But the farmland investor does play a key part. And I would argue most of the farmland investors that we see are going to be local investors. Somebody from the local community that wants to own farmland as part of their investment portfolio. But you can see that weighting 60-40 in 2020, with the farmers still remaining the dominant. Now that's our sales. I would suggest that when you look at the overall marketplace, which would include sales that are off market, meaning landowner to tenant, that percentage is probably higher on the farmer scale. Number of sales compared to previous years. Our staff back on September 1st said 75% fewer sales than they'd experienced in previous years. Largely that April through June, July time period, where we had 10 auctions scheduled for April of last year. And if you've listened to some of our other seminars, we've talked about the results we saw with those. We basically had to convert them all to online only. There were 10 auctions scheduled, 2 online, 8 were live events with an online component. Converted them all to online only. They all sold, 2 didn't sell, 8 sold right where the market was, where we expected it. But then basically after April 17th, we saw no auctions until mid-July. So the market just basically shut down due to COVID. Again, that's planting season, so that's not always an uncommon occurrence that you would have fewer sales anyway. But I think this slide is representative of that time period where we really just saw people say, hey, I'm going to hang on to my farmland. I know what it produces. I don't know what other markets are going to do, especially the stock market. And so they just hung on at that point in time. Dominant purchasers. Now, this is the question I asked, and I said, in the entire marketplace, in all of the market that you see, who are the dominant purchasers? And this I alluded to earlier. Our sales were 60-40 farmer. In this case, you see 70% farmer, 25% farmland investor, and 5% recreational. So the interpretation is that the overall marketplace continues to be dominated by the farmer buyer. Now, I've mentioned this before. I know we've had Jim Mintert speak at this, I think even a year ago, talking about the Ag Barometer. And so those of you that have attended that have heard him describe how they do it. I just have one slide on it because I think it continues to show the sentiment and the attitude as much as anything that exists out there today in agriculture. And you can see that we saw a little pop up. This report just came out 2 days ago. Jim's report showed that it was up to 174. Now this is a 0 to 200 point index. So no surprise with commodity prices coming up throughout the fall, better yields than expected. And oh, by the way, the government support programs that we've seen, that the producer sentiment is still pretty positive today. I think that does factor into what farmland values are going to do into the future. And so we see that as a pretty positive result. You saw a little downturn in December or really the November report. And I think that was largely due to unknowns about the election back at that point in time. But still, 167 is well above average. So let's talk a little bit about farmland debt. Still something to think about. It is creeping up, and so I think it's an important component. This is a slide through 2020 that shows non-real estate in orange, real estate debt in blue, and you can see inflation adjusted. We've now gone above what the debt was back in the 1980 time period. So overall debt in terms of real non-inflated dollars, you'd be talking or adjusted dollars back, you would talk about exponentially high. But really, inflation adjusted, we are above what we were back then. And a larger component of that is real estate debt versus non-real estate, think equipment and operating lines. But here's one of the interesting factors that I think will continue to play out, especially at the interest rate environment that we're in. And if you have questions about any farm loans, First Farmers Bank and Trust would be glad to discuss those with you. And they would confirm this. So back in the 1980s, those of you that were around in that time period, interest rates were double digits. Today, 3, 4, 5% is more of a common number, depending on what you're borrowing and what it's for. And so you see the interest expense being dramatically less. So if we go back, debt, inflation adjusted debt is an all-time high. But look at the interest expense difference. And this factors into your bottom line. And so if you're paying less interest, that is a positive to your profitability. It also is a huge factor for the federal government and the debt that the federal government has. Dramatically different than what we would be looking at if we were interest rates back of the 1980s. Now, here's another way to look at debt, and this is debt to equity, debt to asset ratio. So farmland values, while they did decline, we have not seen them crash like they did in the 1980s. And so while debt has gone back up to that all-time high level, inflation adjusted, we haven't seen the debt to equity or debt to asset ratios do the same thing because farmland values have been holding in there pretty steady. Now, they have been increasing over the last 4 or 5 years as debt has increased and farmland values have remained steady. So that's not a surprise, but still they're at levels that I would argue that are pretty sustainable long-term. Here's another way to look at debt, and this is debt divided by income. So your total debt divided by your income, which is your ability to repay. And you can see that when we go above a 5, that is a concerning ratio, 5 or above. And when that happened back in 1976, 77, that 5.5 way on the left side of this slide, that was a warning sign. And so Pro Farmer, which really tracks this, suggested 3 or 4 years ago that we were above 5, and that was to be a concern, that we needed to watch that closely. But you can see over the last 5 years, that trend line has actually been down. And here in 2020, it's a 4.2 level. Obviously, with farm incomes going up, that has certainly helped, even though in spite of debt increasing slightly over the last few years. Here's the share of delinquencies. And what I basically want to share with these couple of slides is that there's really no concerns out there. Delinquency baseline since 1990 is right about 2.3% of the loans are delinquent. And while we've trended back up to that over the last 5 years, we're just basically at that average number. Likewise, here's a non-real estate loans, basic farm equipment to operating lines. And yes, the trend line over the last 6 years is up, but basically back to what the long-term average is. Volume of delinquent farm real estate loans, billions of dollars. And so no surprise, through the golden era there, the number went down. We've gone back up, but still back just to where we were in 2010. Now, the one concerning part of debt, and we've talked about this in multiple seminars, is this working capital erosion. And of course, there was a lot of cash that existed out there after the 2007 through 2012 time period. And this chart really shows that. There was a 37% working capital to gross farm income revenue ratio back in 2012. But with lower commodity prices, lower farm incomes, you see the erosion of that working capital over the last 7 or 8 years. I bet that number pops back up as we look at 2021 because of the income, the higher commodity prices combined with the government program payments that have been received on the farm this past year or two. And then real working capital, so inflation adjusted, but again, showing that same kind of trend where we've seen it erode in overall total dollars the last few years. Wow, it was pretty favorable back there in 2010, 11, and 12. And so with that excess cash out there, really no surprise that we saw farmland values go to some of the levels that we did as that cash got reinvested into assets that farmers would own for a long period of time. Bankruptcies. I did read that Iowa bankruptcies were up this year, and I didn't see the data on that. But because I read that article, I left this slide in here. I don't think this is going to be a major concern in 2021, thankfully. But I did leave it in here just for perspective. Those of you that have been to my seminars have seen this before. But in 1987, there in the middle part of the slide, all across the United States, the entire country, almost 5,800 bankruptcies, Chapter 12s, were filed that year. In 2008, that had dropped to 250, almost a negligible number, not to those that had to file, but a pretty low number at that point in time. Now you can see where we have trended to. In 2018, that got to almost 500. In 2019, it was over 600. So that was a 23% increase. So that's concerning, right? But I think perspective is important. And while it is concerning that we are increasing, we're still somewhere well below 1,000 bankruptcies across the United States compared to where we were back in 1987 at almost 6,000. So keep them in perspective. So where do farmland values go from here? It depends on these three things, and typically has always depended on these three things. One is farm incomes. And so no surprise really that back 2007 to 2013 made a lot of money. That working capital increased. So some of it was reinvested in farmland, and we saw values go up during that time period. Likewise, we've seen farm incomes lower since 2013, and that cash drain, that working capital, has eroded, and farm values then trended downward, at least initially in that time period, and then have remained steady. So farm incomes have a significant factor, maybe 50% of the weighting on farmland values. So let's talk about interest rates, because they are important as well. And interest rates this past, 9 months have dropped quite dramatically. I talked earlier about the number of appraisals that the Halderman companies did, a lot of them for basically refinancing. If you look at the housing market in the United States, a lot of that was driven off the fact that interest rates are extremely low in the housing residential space, and that helps drive that market as well. So interest rates are a factor, and we'll talk about why in a second. And then supply of farms. And so the supply of farms that we see for sale, supply and demand, it's always an economic driver,
that supply has really remained pretty low, below average for 4, 5, 6 years. One of the reasons for that is that there was really that, I mentioned earlier, no outside driver, no tax law change, no farm bill change or something like that to cause people to want to sell. But if you go to, there was a study that Iowa State University did a couple of years ago, and they looked across the entire state of Iowa, and they said land ownership, the number of mortgages on land in Iowa, farmland in Iowa, they tabulated it all up, and 80% of the farmland in Iowa has zero debt. So even though incomes were challenged the last 5 or 6 years, we certainly have not seen a tremendous amount of debt out there on farmland, and therefore no real stimulation to have to sell farmland. So that supply number has remained below normal. So when you look at those three factors, farm incomes are the heaviestly weighted. They've been down, so farmland values came down. But interest rates and supply really have been, compared to long-term historical numbers, they have been both bullish throughout this entire time period. Now, before we talk about the great times that maybe we're looking at right now, if you were to sell corn at $4.90 or whatever the price is in Tipton County today, $13 soybeans, that's great times. You know, those are numbers that we've seen very briefly in terms of long-term commodity price history. Very brief periods in history have we been at that kind of level. But if we go back 6 months ago or 9 months ago, we weren't looking at commodity prices at that level. And government support has been absolutely critical the last 3 or 4 years. When we got into the trade wars with China, lower commodity prices, and we saw the TFP, the trade market facilitation payments that really helped offset some of the declines in commodity prices. Likewise, the CFAP payments that have come out this year to help offset the COVID problems that were related to, that impacted commodity prices back in the spring. So don't miss that government support. We'll got to talk a couple about at least a couple slides on that. And then interest rates still historically low. And I always like to make the point when we talk about interest rates, my first car loan in 1988, and this was after the highs, my first car loan in 88 was 8%. And so when you look at your ability to borrow money on farmland and somewhere in the threes today, that's a pretty appealing interest rate. And then, as I said earlier, farms for sale are about 3/4 of the normal 2%. Farm income. So we'll talk a little bit about that. You know what? I changed this slide from what I had earlier. Farm income, $700 to $1,000 an acre gross. Now you might be laughing and say, well, Howard, what are you growing hemp to or marijuana to grow that $1,000 an acre gross? No. Who out there had 220 bushel corn this year? If you take that times 450, you start to look upwards of $1,000 an acre gross. If you add in the government program support payments, you might be close to that $1,000 an acre gross. So that's not out of the realm of possibility, but certainly farm incomes have moved up. Now, I'm not suggesting everybody sold 100% of their crop at that level. Likely, you started selling back in September when prices had moved up. You took advantage of better pricing opportunities because we didn't know what the future held. So I fully get it that your average won't be there, but the potential does exist on some instances. Total production costs, you can see this is the basic estimate from our staff, you know, what it cost with rent to put out an acre of corn or soybeans. Highly variable, especially on the beans, largely dependent on how farm operators choose to spread their fixed cost across the farms. So that last point on this slide, I think, is important. Demand is certainly up for farmland to rent. And that's not a surprise. When you see higher commodity prices, typically demand for rent goes up. Now, I pulled this slide out of a presentation a couple of days ago because I thought this was important to get the most updated numbers to you. And so right now, USDA is projecting net cash farm income, and I know this is a little bit blurry, but net cash farm income to be up to $134 billion. That is up substantially from earlier predictions. And then you can see the net farm income, the green line or the blue line, depending on your slide, is up to $119 billion. up dramatically. And that's the government payments combined with these higher commodity prices. So that's why I suggest to you out there that there is some additional demand for rent, and likewise that's going to follow through into land values. Now let's talk about that impact of USDA payments in a graphical chart. Here is the real government program payments to farmers going all the way back to 1970. Don't miss that 2020 is the all-time high number. This is inflation adjusted. Yes, there were some substantial payments made around the year 2000. Yes, there were some in the middle 80s, but this past year eclipsed all of them. And a lot of that was due to the COVID relief that we saw coming out, as well as the market facilitation payments. So here's the farm income and direct payment breakdown. So 2020 net farm income is going to be up, but that orange part of that bar is still fairly substantial. If you look at the blue part of the bar, net farm income, yeah, it's up a little bit from last year, but it really isn't above 2018 and 2017. So without the government program payments, 2020 wouldn't have been as special a year from an income standpoint as what it ended up being. And then real net cash farm income less government program payments is actually trending down. Now these guys with out of Nebraska, Brent Gloy, helps put this newsletter together. You see the watermark back there on the slide, AEI.ag. I would highly recommend you look at that website. They send out a weekly newsletter. It's brief in terms of a read and a lot of really good information. And they some of these charts I pull out of there. But I really thought this was impactful. When you look at the actual inflation-adjusted net cash farm incomes, when you take the government program payments out, actually 2020 is still down. And that was due to those low commodity prices for, 7-8 months of the year, almost 9 months of the year. Here's the Indiana Farmland Cap Rate. And I want you to think about this. So what this is net, it's easiest to think about it in terms of cash rent. So take cash rent less real estate taxes, insurance, and you end up with a net cash return per acre divided by the value of the farm. And that's been hanging right around that 3% number for the last few years. That compares to other investment alternatives that an investor might consider. So if you looked at CDs, those rates are point something today. They were above, you could get up to 2% the last few years, or maybe 2.5%, depending on the term of the CD. But CDs don't have any opportunity for appreciation, but they are a barometer to compare to farmland investing. But the interesting thing is, how does this compare to the cost of the money you might borrow against the farmland return? And for the last few years, interest rates for your borrowing have been above the 3% cap rate. And so you really don't enhance your overall internal rate of return by using debt to buy that farmland. However, today, depending on who what financial institution you talk to, those numbers are a little more comparable. So if you used a 50% debt on a farmland purchase, you could be looking at a situation where your overall internal rate of return is actually enhanced a little bit with the cap rate somewhere around 3%. But that just shows that sideways channel again that we've been in from an income and value standpoint. So we'll talk quickly about leasing. I think this 2017 Ag Census data is kind of interesting in terms of the consolidation. And no mystery, everybody knows that this is well underway, both in livestock, more in livestock than it is in grains, but it is underway in grains too. 2002, 6.7% of the farms produced 75% of the overall sales. That number drops to 5.16 in 2017. Again, not a surprise. What is interesting is that next point, the fifth bullet point, farms producing 75% of the sales. So the largest farms out there, it's only 5% of them. They own 37% of the equipment. So a majority of the equipment is owned by the people producing the smallest number of sales. Yeah, we've known for years that most farms have more equipment than what they need. And if you're a farm producer, you're going to sit there in your office today and say, yeah, Howard, when we have 1 week to plant that's dry in Tipton County, we need to go. And I get it. You need the bigger equipment to be more efficient when the timing is right, because we have narrow windows for planting and harvest. So that is the argument as to why those numbers are what they are. You had over 10% of the farms out there, the largest farms, over 10% of them had some organic sales. I found that interesting. And then under expenses, those largest farms did so on 70% of the expenses. So they had 75% of the sales, but they did it on 69% of the expenses. So therefore, scale has benefits. They're able to buy things cheaper because they're buying larger volumes. So cash rents, this was our opinion. Again, our results, our opinions from September 1st. So I would argue that all of these would be more bullish today than what they were then. Back then, early in the fall, results of any 2021 cash rents negotiations, and you can see that most of our people hadn't negotiated any rents back at that time, but most people were looking at steady from 2020 rates to 2021. I asked, would you lower any cash rents? And surprisingly, today, you might say this is crazy, but 7 of our area representatives were willing to lower cash rents back on September 1st. How times changed in the last 4 months, basically. The consensus back then was that ultra high rates will come down, but otherwise we were anticipating a steady leasing year from 2020 to 2021. And then you would have some random changes on individual circumstances. I asked about demand, and you'd think coming through COVID, maybe demand would be a little lower. So what we saw is, first of all, is there more or less of the same amount of farmland for rent in 2021 versus 2020? And there were more. At that point in time, the feeling was there were going to be more farms available for rent. But demand was basically going to be the same, maybe a little weaker. Now, same means that it's fairly strong because we've had pretty good demand for farmland throughout this entire time period. Would you have any tenants default on leases? 0. That's not an uncommon number for us. Will you have tenants give up the lease rather than renegotiate? And again, those of you out there listening this morning may be laughing, saying, well, no, I wouldn't give it up. Well, that's easy to say today with what commodity prices have done. But if you go back to September 1st with $3.50 corn, that's a different answer maybe. And you can see that 5 of our people thought some tenants would give up their lease rather than renegotiate. Cash flex leases. This is the argument for cash flex leases. Most of our people have implemented a high percentage. That's that point on the bottom. And I really think that's a fair way to do it when you see commodity price swings like what we've experienced this year. Yields were above average, probably, 5-year average maybe, above that, but not super in many instances. But basically, when you see these commodity prices do what they've done, that cash flex yield type of lease really helps generate a bonus when a bonus is due, when it's a good year. And when you start to look at the government, the net cash farm income escalating the way it did, should the landowner maybe share in some of that, and it's lower than 50% of the upside, maybe 25 or 33%, yes, the landowner should benefit from that. And that ensures long-term tenancy, and it eliminates the risk of a tenant losing a farm because somebody offers a super high cash rent. But I think all of those results probably would receive a different opinion today than what they did back on September 1st. Base gross revenues in those cash flex leases, our range was anywhere 600 to 750 an acre on corn and 450 to 550 on soybeans. Midpoint of that would probably be the base gross revenue number that we would be using most of the time. And would we change any base cash rents? And again, we were looking at a pretty steady negotiation year over year. Here's the Purdue survey on cash rents, and you can see them ticking up for 2020, pretty much across the board. Again, this was for 2020, not for 2021. I would imagine we might see a tick up again in 21. And then here's the USDA survey, and you can see over the last 4 years, a slight upward trend there as well, just like the Purdue survey shows. So where do we go from here? And in the last 15 minutes or so, we'll wrap this up. So long-term world demand fundamentals remain bullish, and we're seeing that play out. And I added this point there at the bottom, just-in-time delivery impacts. For years, I think there was a lot of grain that was stored around the world. in a lot of different locations. And we've seen the impact of the just-in-time delivery mentality. That's existed in manufacturing for a number of years. But I think in agriculture, we've gotten to that point. And so when you see China expand their swine herd quite dramatically, like they've needed to, when you see the impacts of maybe a drought in Argentina this summer for them, a winter for us, that just-in-time delivery starts to have a material impact in commodity prices. So that long-term world demand fundamental exists. It does play out, and especially at times like this. Interest rates still favorable, and you can see that 4.24% real estate mortgage rates in the 7th district. That is the lowest, and that's a 15-year fixed rate is the way they asked that question. That's the lowest ever in recorded history for the 7th district. So when I talk about interest rates being pretty favorable, they are. Supply of farms for sale remains low and even lower right now. You know, I looked at the farm papers this week and there's just very little even being offered out there. So supply is positive from being a bullish. And then, but government support for 2021, that's a couple question marks, maybe 10 question marks. One would argue that I wouldn't count on much. You know, you've got ARC and PLC, the part of the regular program, those may not even pay out. And hopefully we'll see support for crop insurance not change, it shouldn't change. Hopefully the RFS remains where it is. And if that's all we get, that might be all that you see. We may not see additional government support in 2021. I certainly wouldn't put it in the budget. And is cash increasing? And I suspect it probably is, based upon the farm incomes from last year. Cropland values are in an uptrend. You know, 6% was kind of the indication from the Chicago Fed Reserve. Our trends would show that kind of increase. And we see for seed markets in timber, recreational, and rural residential, they were stronger all last year, and they probably continue to be fairly positive. We still see those average to below average farms, those hassle farms, being less desirable. And we had a few of those this fall that we offered, and the bidding was just weaker. It was just slower. And so there's still that desire for that average to above average farm, that more efficient to farm is in demand out there. So where do we go from here? Now I'm going to tell you, the bullish side of me wins on this. So really look at this, and when you look at this slide compared to the bearish one that's next, right now the bulls are winning. You got profitable prices, both for 20 crop as well as 21 crop. Low amount of debt to assets in agriculture, low interest rates, low supply, biofuels. Got to watch that. But does the Biden administration really change the RFS to any large degree? Right now, ethanol plants aren't making much of any money. So I think that bears watching. World population growth, we know that one. Trade deals have been helping, I would argue, over the last 12 months. Potential for inflation, it certainly exists out there with all the money that's been printed by the federal government. And then water resources and competition, and we sit in a pretty good spot with regard to that. So I said the bearish slide is my loser today. These are things that could happen. And then really the question I have for all of you, what's the black swan this year? What is the black swan event that was COVID last year? We don't know what that will be. No one can predict about black swan. That's why they're named that. But last year we had that pandemic. We had the COVID-19. Is there a mutated version of that has an impact on demand or prices? Or does the vaccines basically and herd immunity get us past this? That's really what it will be interesting to watch over the next 2 or 3 months. You've got weather impacts and trade. Right now, Argentina's dry. What happens if it starts raining in Argentina and Brazil and the crop prospects change down there, combined with pretty good crop prospects for the US this year? That could have a negative impact on prices. Trade. I don't know how that'll go with the Biden administration. You got to watch that. Global production, it's been enough. That could lead to lower commodity prices. You could have the worldwide economy tank. Again, I'm not arguing for any of these. I'm just pointing out these are things that could happen that could be a problem. biofuels RFS mandate, trade agreements. Interest rates could eventually start to increase. I thought it was interesting yesterday. I don't know if anybody pays attention to this, but bank stocks. You know, the overall Dow Jones didn't move a lot yesterday, but bank stocks went up dramatically. I've got 3 that I have on my 10 stock things on my iPhone, and all 3 were up fairly substantially yesterday. I would argue that that suggests that there is a feeling that interest rates might be going up, and net interest margin, which is the biggest income driver for a bank, would go up as well. So that's the bearish side. Interest rates increasing would be maybe negative on farmland values. So other asset classes, you got to watch the returns, the stock market, but really more so liquid treasuries and CDs. Right now, farmland's a winner in that. Does that change somehow? Working capital concerns, I kind of think that's over for right now for 2021. But we were at a pretty low number coming into this year. So I think right now you got some pretty bullish fundamentals. You got higher prices. That's going to equal demand for rental land, and that's going to equal higher land values. So if I've got any prediction for this year, I think probably slightly higher rents combined with higher land values will be the theme. Higher, maybe 5%. I don't think we go crazy on this by any means, but certainly we're in a bullish uptrend, and that probably follows through to land values as we look forward. So with that, Stephanie, what questions have come in?
Okay, so we do have, the only question in the chat box is if you're willing to share your presentation with participants today so they can look back on it.
So great question. Austin is recording this. So if you want to, not that you want to see me again, but you could, and you could get a recorded version. But yes, if you share your email address, and you've got my email address here on this slide, so you could just quickly write down howardh@halderman.com, shoot me an email, and I'd be glad to send you this presentation. So yes, it is available to answer the question quickly. And that's how they would just reach out to me, and I'll get it to them.
Awesome, thank you. Do we have any other questions for Howard before we transition to something else?
Well, again, I want to thank everybody for joining in. I think our participant numbers are nearing 100, Austin. That's outstanding. Just really excited about where agriculture is headed in 2021. Again, we're an essential industry. We've been blessed. There are many industries that have not been. And I feel for all of those folks, pray for those folks that are in the restaurant, hotel, and hospitality trade. Hopefully this COVID will pass soon and we'll be able to get back to more normal times. But agriculture has been blessed, and we're thankful for all the work that you do as producers out there. And at this point, I think, Austin, you'll transition to some topics that will help them maintain their licenses or certifications for this year.
Actually, we've got a couple of questions that have come in through the chat box here. How should we handle Carter-era inflation and interest? We farm and invest in farm and run a global manufacturing company. Inflation pressure is among us.
So historically, farmland, it performs well, and it's an inflation hedge. So if you are invested in farmland during inflationary time periods, that tends to be a positive. At the same time, I would be cautious on debt. So if you're borrowing money to buy farmland, make sure you fix your interest rates at these low levels. If you go back to that Carter era and the high interest rates that we experienced, a lot of the mortgages were on a variable rate. I think that would be a no-no today. I personally buy with only fixed rate mortgages at these levels. So I think that's how you could kind of insulate your business, is trying to do things more on a fixed rate at low interest rates and stay away from debt if you can. But farmland, from a value standpoint, tends to perform well during inflationary times. Was there another question, Austin?
Yeah, I have one that was sent to me directly. Any comments specifically on what kind of effect an elimination is in stepped up basis or elimination of the 1031 exchange might do to the farm real estate market?
Another great question. That is something that I think bears watching. So right now, if Farmer Smith owns his farm and he passes on, it gets a stepped up basis, and then the heirs could sell that in theory at that appraised number and not pay any capital gains tax. If that loophole goes away and you don't receive that stepped up basis, that would argue that those heirs, when they inherit the farm, might look at it and say, well, gosh, dad paid $1,000 an acre. It's now worth $8,000 or $9,000. We don't want to pay that capital gains tax, so we'll just hold on to the farm. So it may argue for lower supply, Austin, a fewer number of farms out there for sale, and certainly more costly to sell. And now, if they eliminate the 1031 loophole as well, then those heirs could look at it and say, yeah, I want to sell the farm and I'm going to trade it. I'm going to do a 1031 exchange into property elsewhere. If that's gone as well, I think that really slows down the trade of farmland that you see to some degree. Likewise, we do see some 1031 exchange money that rolls out of residential development into farmland. And so that could, to some degree, offset, I suppose, the lower supply, because you would have less demand from those 1031 buyers. And that really would be an impact in areas like Tipton County, where you're in that donut county around Indianapolis, and you really see a lot of that 1031 money from those larger metropolitan areas spinning out. Any other questions?
Yeah, so we have a question here. They were asking if it's recommended they purchase as much land as they could at today's interest rates.
That's a good question. Personally, I'm buying land. So should you buy as much as you can? I think ability to repay needs to be a factor in that decision. And you need to project out, can I make these payments under a wide variety of scenarios? I sit on a bank board, and one of the things we have to do is stress test. And so I'm going to buy this 160 acres. I'm going to borrow 50% of the purchase price to do it. That's going to cost me X amount of dollars per year on this fixed rate mortgage to pay it back. So stress test it. What kind of commodity price times my average yield must I achieve to make those payments? Paying off all the other costs, management, life, living costs, and all of that. And that really needs to remain how you make those business decisions, is that ability to repay. Where we got into trouble in the late 70s was a lot of there was a buy all the land you can, use debt to do it. And the ability to repay was less of a concern or less of a factor. I think it needs to remain a primary factor in your decision making. So I wouldn't go out and buy land willy-nilly at these low interest rates just because they exist. It's really, can I make the debt payments? Can I service the debt? And can I do it at 325 corn? And can I do it at 425 corn? And that would be what I would want to look at.
Thank you. I've got one more question here. How much farmland does China own in the U.S.? And I don't know if you'll know that, but
I don't, Austin, but I would tell you it's a very low percentage. They own other forms of real estate in the United States, but I am not aware. Me personally, I'm not aware of any purchases of land by a Chinese organization. Now, we manage land I have a Danish client. I have German clients. I have sold farms to Argentine groups. So certainly there is foreign ownership of farmland. Make no mistake about it. It's a very small percentage of the overall marketplace. But I'm not aware of much of any Chinese-owned land.
Okay. All right. Well, thank you. I'm not seeing any other questions here. Howard, thank you again for your flexibility and being able to present on today's call. I think you did a great job, and hoping that the audience enjoyed viewing it from either their office or on their couch or wherever they're enjoying it